What if I told you the American dream of owning a home is quietly turning into a financial nightmare? While most people are still clinging to headlines from last year, the reality on the ground has flipped, and fast. The same homes that sparked bidding wars in 2021 are now sitting empty, prices are slipping, and some sellers are straight up panicking. Sound dramatic? It's not, it's data, and if you're not paying attention, you could end up on the wrong side of this shift. Forget what they taught you about real estate always going up. That belief is crashing harder than a stock on bad earnings. In 2025, we're seeing the biggest disconnect between buyer power and seller expectations since the great financial crisis. Mortgage rates are soaring, inventory is exploding, and homeowners, they're freaking out, rightfully so. This isn't fear-mongering, it's a wake-up call. But here's the twist. With chaos comes opportunity. If you understand how the game has changed, you can actually use this collapse to your advantage. That's what this video is all about. Breaking down what's really happening, why it's happening, and how to position yourself to win while others retreat. Let's dive in before the rest of the market catches on. For the first time since the great financial crisis, the US housing market has flipped, and not in the way flippers like to brag about. We're now seeing a full-on buyer's market, where sellers are outnumbering buyers by over 500,000 homes. That's not a small glitch in the matrix, that's a seismic shift. Homes are sitting longer on the market, some gathering dust like unopened wedding gifts. And when 61% of US markets are seeing prices fall, you know this isn't a drill. This isn't just about numbers on a spreadsheet. It's about real families trying to make money, retire early, or just find a place to raise their kids. Homeowners who once felt like kings in a seller's paradise are now facing a harsh reality check. Imagine listing your home, expecting a bidding war, and crickets. That emotional shift is massive. Suddenly, people are realizing that the financial freedom they thought real estate promised may not be as bulletproof as it seemed. The good news? For savvy buyers and long-term real estate investing strategists, this is a golden window, the kind Warren Buffett would smile at. He famously said to be greedy when others are fearful. And guess what? Sellers are fearful. If you've been waiting for a crack in the market, it's here. But before rushing in, it's crucial to understand why home prices falling isn't just about price tags. It's about momentum, psychology, and timing. Now, let's talk momentum. This isn't a random dip. This shift has been building slowly, like pressure under a volcano. One of the main culprits? The domino effect triggered by rising mortgage rates 2025, making monthly payments borderline ridiculous for many. Combine that with increased inventory, buyer hesitation, and inflation, and you've got a housing cocktail that's about to spill over. Spoiler alert, the next ingredient in this mix might just be what kills that momentum entirely. And that takes us straight into a bigger question. What happens when prices stop climbing? Not just slowing down, but actually starting to lose steam altogether. What happens to the promise of equity growth? What happens to flipping homes as a side hustle or part of your online business strategy? Let's dive into that next. The truth is, home prices are running out of gas. While the year-over-year numbers might still show a slight uptick, don't be fooled. We're not in 2021 anymore. Back then, 15-20% gains were common, and it felt like every open house turned into a bidding war. Now, growth has fizzled to a mere 3 to 4%, and in several markets, we're already seeing real declines when adjusted for inflation. That's not just a slowdown, it's a signal. Think of it like driving uphill with a heavy load. At first, you accelerate. Then, you struggle to maintain speed. Eventually, gravity wins. That's exactly what's happening in the housing space. And for homeowners banking on quick appreciation as part of their Real Estate 2025 plan, this could be a rude awakening. Financial freedom becomes harder to visualize when your asset isn't climbing like it used to. So what does that mean for someone trying to make money through real estate today? It means timing matters more than ever. Buying at the top and holding through a flat or declining phase could crush your return. That's why the pros are looking for distressed sellers, off-market opportunities, or even shifting toward rental income models for more stability. Passive income, not price pumps, is where the edge lies now. Another interesting consequence of this price stagnation is its impact on mindset. Many casual investors, those who jumped in during the boom, are pulling back, unsure whether to stay in or cash out. This hesitation adds to the slowdown, and if fewer people believe the market will grow, fewer people will buy, creating a feedback loop that reinforces itself. Psychology is now steering the market just as much as rates and inventory. Which brings us to the next big pressure point: mortgage rates. If prices are slowing and momentum is weakening, high borrowing costs could be the knockout punch. So let's talk about what 7% mortgage rates are really doing to the average buyer in 2025, and why it's reshaping the very foundation of home affordability. Mortgage rates aren't just numbers, they're gatekeepers. And right now, they're slamming the gate shut for millions of potential buyers. At around 7%, the average 30-year fixed mortgage in 2025 has doubled from just a few years ago. That means monthly payments near $2,160, and for many families, that's simply unsustainable. The dream of home ownership is becoming harder to reach, not easier. This affordability crisis is no longer just a future risk. It's today's reality. A couple earning $100K combined used to qualify for a $500K home. Now, they're lucky if they qualify for $350K. That crushes buying power and pushes people out of the markets they once considered starter neighborhoods. So even though home prices falling seems like a good thing, the benefit gets swallowed by soaring borrowing costs. And here's the kicker: these high rates are sticking around longer than expected. The Fed may ease eventually, but inflationary pressure, global instability, and consumer debt levels are keeping the brakes on. That's why real estate investing now demands sharper strategy. You can't just buy and hope. You need to run the numbers, negotiate terms, and in some cases, get creative with financing. Think seller carrybacks, lease to own, or short-term rentals. Ironically, this high-rate environment is also shifting focus to alternative paths to make money, like digital real estate and online business models. Why? Because for many, launching a scalable side hustle feels more doable than locking into a 30-year mortgage at 7%. Financial flexibility becomes the new wealth, and freedom isn't found in square footage, but in options. But high rates alone aren't the only reason buyers are pulling back. There's another big one coming around the corner, one that's flooding the market with choices and tipping the power dynamic even further in favor of the buyer. It's inventory. And oh boy, it's rising fast. Inventory has exploded like a soda can in a hot car. We've now seen 81 straight weeks of year-over-year growth in listings. Over 1 million homes are sitting on the market, the highest level since 2019. This isn't just a fluke or seasonal uptick. It's a tidal wave triggered by rising mortgage costs, job insecurity, and folks cashing out before home prices falling even more. Sellers are motivated, sometimes desperate. Some need to move for work, others are tapping equity while it's still available, and some are simply scared they missed the top. It's this fear that waiting too long means settling for less that's creating what looks more and more like a housing market crash in slow motion. For buyers, though, it's a buffet of choice and leverage, but not all listings are equal. The best properties still attract attention, especially those priced right, in solid school districts or in high-demand metros. That said, homes with inflated prices, bad photos, or hidden issues, they're sitting and sitting. That's why serious buyers need to act like investors, inspect everything, negotiate hard, and be ready to walk away. There's power in patience right now, and this isn't just happening in 1 or 2 cities. It's widespread. From Austin to Phoenix, Tampa to Boise, metros once on fire are now cooling, or flat out freezing. Even vacation markets and second home hotspots are feeling the chill. And as this inventory pileup grows, one particular segment of real estate is starting to collapse faster than the rest: condos. Let's turn the spotlight on that, because if houses are under pressure, condos are getting crushed. If the housing market is wobbling, condos are downright tumbling. Listings are up 83% compared to offers. That's not a typo. It means for every offer, there are nearly double the number of units sitting, waiting, hoping. And the reasons are stacking up: rising HOA fees, skyrocketing insurance costs, and the fact that condos just aren't appreciating like they used to. That dream of quick real estate investing profits? Not here. Let's talk Florida, because it's one of the hardest hit states. Miami, Tampa, and Orlando are seeing steep declines in condo demand. Part of it is regulatory. Post-Surfside collapse rules are stricter, but part of it is emotional. People don't feel safe buying into aging towers with uncertain repairs and unpredictable dues. And with home affordability already stressed, buyers want more value, not more risk. Even for those looking to make money through rentals, condos are losing appeal. Rental restrictions, special assessments, and maintenance nightmares turn what once seemed turnkey into a headache factory. Investors are backing out, leaving behind a pile of listings that grow stale with each passing week. This isn't a hidden trend. It's visible. It's loud. It's a neon sign flashing, "Warning." And when a segment crashes this hard, it affects the broader perception of the market. People start second-guessing all real estate, not just condos. The fallout is psychological, and it spreads. That shift in buyer sentiment is crucial, because once confidence cracks, recovery takes time. And it's not just the numbers, it's the mindset that determines the next move. Which leads us perfectly into the next chapter of this story: how buyer psychology has flipped entirely, and why that alone could keep the market cold for much longer. Just a few years ago, buyers were terrified of missing out. Now, they're terrified of buying too soon. This psychological flip has become one of the biggest forces shaping today's housing market. People aren't asking, "How do I beat 10 other offers?" anymore. They're asking, "What if I overpay and regret it for the next 30 years?" That's a huge change in behavior, and it's rewriting the rules. The job market plays a big role here. With headlines of layoffs, hiring freezes, and rising unemployment, many potential buyers are choosing to wait, not because they can't buy, but because they don't want to commit under uncertainty. Financial freedom means being mobile, having options. A 30-year mortgage feels like a prison sentence when you're not sure your income is secure next month. This hesitancy is powerful. It causes homes to sit longer. It weakens seller leverage. It emboldens negotiations. Buyers are asking for price drops, closing cost credits, and inspection repairs, and often they're getting them. What used to be a seller's market of speed and scarcity has become a buyer's market of caution and strategy. And this psychological shift isn't going away soon. In fact, it's fueling creativity. Buyers are exploring rent to own, co-buying with friends, or building online business streams while they wait. The goal isn't just to buy a home, it's to buy smart and to maintain freedom along the way. The traditional American dream model is being questioned, and that questioning is making space for smarter plays. And speaking of smarter plays, let's look at how builders are responding. Because when buyers hesitate, sellers adapt. And builders have come up with a clever way to keep things moving without officially lowering prices. Home builders are playing chess, while many think it's still checkers. Instead of dropping prices, which would hurt their profit margins and tank market comps, they're offering mortgage rate buydowns. What does that mean? They help reduce the buyer's interest rate temporarily, making the monthly payment more manageable without officially lowering the sale price. It's a sleight of hand, but a smart one. This strategy keeps Real Estate 2025 data looking strong on paper while still enticing hesitant buyers. Instead of seeing a home price fall from $500K to $470K, a buyer might get a 4.99% rate for the first couple of years, saving hundreds per month. It's psychological, it's clever, and it works, for now. But buyers should still do the math and look at the long-term cost. This is also a response to the broader shift in home affordability. Builders know that a lot of people can't qualify anymore with 7% rates, so they're creating temporary breathing room. And while this feels helpful short-term, it can become dangerous if buyers aren't prepared for their payment to jump after the incentive period ends. You don't want a budget surprise 2 years into a 30-year commitment. On the flip side, this builder tactic keeps comps high. That helps maintain neighborhood value, but it also keeps many resale sellers from lowering prices. If your neighbor's new home just sold for 550K, even with incentives, you'll want to list yours for the same. This artificially props up pricing data, even when demand is weaker, and investors need to watch for this illusion when making decisions. But while builders are working hard to keep appearances up, buyers are quietly gaining more control than they've had in years. More options, more time, and more negotiating power. And that, my friend, is a recipe for a completely different market experience than we had in 2021. Buyers are finally back in the driver's seat. After years of feeling like desperate auctioneers, they can now pause, assess, and strike deals. This shift is empowering, but it comes with a twist. Even though it's a buyer's market, home affordability is still a mountain to climb. Prices are softer, yes, but high rates and stubborn comps keep monthly payments elevated. So buyers must be sharp, not just eager. That said, this market rewards the prepared. Pre-approved? Great. Flexible on move-in date? Even better. Willing to negotiate on repairs, credits, or closing costs? That's the new norm. A buyer today can walk away with 20K pluses in savings simply by asking for the right things. It's like walking into a car dealership. If you pay sticker, that's on you. And the best part? You no longer have to settle. Want a south-facing backyard? A home office with windows? A walkable neighborhood with a good coffee shop nearby? You can actually find it. The desperation has cooled, and with it, the pace. That means smarter decisions and better outcomes, especially for those thinking long-term about real estate investing or house hacking strategies. Still, buyers shouldn't assume they can wait forever. When the market stabilizes, and it will, many of these perks will vanish. That's why pairing market knowledge with action is key. Whether it's finding fixer-uppers, multifamily deals, or creative seller financing, this is the season for strategic moves. The goal isn't just to make money, it's to build leverage and legacy. And speaking of leverage, some of the best returns in real estate aren't found in new builds or flashy flips. Sometimes it's about working with what you already own, or what others overlook. Let's talk about one powerful example: turning garages into gold mines. Want to know one of the smartest plays in today's market? Building an accessory dwelling unit, an ADU, right in your backyard. Think about it. That unused garage or guest house you barely step into could become a 2-bedroom rental generating passive income every single month. That's not theory. That's exactly what the creator of this idea did, and the returns are real. Turning a garage into a small unit might cost 80, 120K, depending on location. But in areas with high rental demand, you could bring in $1,500, $2,000 per month. That's a solid online business right there. But in brick and mortar, it's tangible, scalable, and tax efficient. And most importantly, it's under your control. No stock market roller coaster, no tenant drama if you screen well, just clean, consistent cash flow. This kind of real estate investing is what Warren Buffett would call boring and beautiful. It's not sexy, it won't go viral, but it works. And in an era where home prices falling is the headline, creating value from nothing is a rare kind of genius. You're not at the mercy of comps, you're adding square footage, functionality, and income to your property. Plus, this kind of move builds long-term equity and opens doors for future refinancing, inheritance planning, or simply lowering your own housing costs. You can live in the main home and rent out the ADU, or flip the script, or Airbnb it during peak seasons. The flexibility is incredible, and the financial impact is lasting. This isn't just about make money, it's about mastering your financial puzzle. And now that we've unpacked every angle of the current housing market, from buyer behavior to builder tricks, from affordability gaps to strategic plays, it's time to tie everything together in a message that shakes people up and makes them think differently. Now that you've seen the full picture, let me ask you something. Are you going to sit back and wait for the market to go back to normal? Or are you going to act like the 1% that sees opportunity where others see fear? Because here's the truth. The game has changed. And those who adapt will be the ones who build real financial freedom, while the rest keep chasing headlines and missing the moment. You've got tools now. You understand the shifts in the housing market, the impact of mortgage rates 2025, and how home prices falling isn't the end, it's the beginning of a new kind of strategy. So what are you going to do with this insight? Are you going to build an online business to boost your income? Are you finally going to start your real estate investing journey with clarity instead of confusion? Drop your thoughts in the comments. I want to hear what your next move is. Are you buying, renting, building, or waiting? Your answer could inspire someone else who's right on the edge of a decision. And if this video gave you that aha moment, that clarity you've been needing, do one thing for me. Hit that subscribe button and turn on notifications. This is just the beginning. We're building a smarter generation of homeowners and investors, one video at a time. Your next step starts now. Let's go.